This is a high reliability metric to say we are in for a bull run for the next 6 months or even longer. It could go for another year. So it's a very good time to be accumulating. We've just coming out of this reaccumulation phase and can see that on chain very clearly. As we did this dip, it was an accumulation. It was not a bear market. There's a whole series of these metrics which I've labeled supply shock. This is the equivalent of on-chain demand and supply. It's an alternative to stock to flow. It's an on-chain model, and we're looking on-chain for different ways in which to measure demand, which demand is like if you're holding Bitcoin every day, you're saying that's HODL demand. I'm holding it. I want exposure to the asset. We look at the coins that are like that may potentially be supply. These are the coins that aren't locked up in long-term holding situations. They look likely they may be sold. So you can run the ratio between demand and supply. So those guys that aren't selling are on the demand side, and the guys that might be selling are on the supply side. And you get a whole family of supply shock metrics. And Will Clemente was the first to suggest this in running this ratio. He suggested doing it on this thing that Glassnode created called liquid supply. Look at the behavior of individual holders and their history, so that we could kind of validate what was happening on exchanges. We were seeing that the coins were starting to deplete out of the exchanges and move into long-term storage. But I really wanted something that was more forensically accurate than just exchanges, because exchanges are very reliant on you tagging particular wallets as being owned by exchanges, and there's a lot of data errors. So they created this metric, and it's called liquid supply, and it looks back and it goes, all right, for this cluster of wallet address spaces, because on the blockchain, obviously, you only see addresses, you don't know who it is. They forensically cluster all of these address spaces together, and they resolve them to individual holders. Now you've got the individual holders, you look back across their wallet history and you go, okay, there's three categorization. What I call the Rick Astley, the guy that just keeps stacking and does not sell. For every 3 Bitcoins that's bought, no more than 1 Bitcoin moves out or sold. So anything that's stronger than that is what you call like illiquid. They're not selling. And then you've got 2 other tiers which get more and more liquid. The high liquid side is just totally nets out to zero consistently. So they're full on speculators, and then you've got the middle kind of swing tradery, part hodly guy. So you can run these supply shocks, and you get the original liquid supply shock, and that's a very good metric, even down into trading a 5 day sort of swing. And then you've got this, what we're looking at here, which is the long-term holder supply shock. If you were to look into wallets, and because as coins enter a wallet, they kind of age like fine wine. You can measure how long the coin stays inside the wallet, and there's a probability distribution that you can see. Like if this coin is dropped into a wallet and it's been there for 1 day, statistically the probability of it moving tomorrow or the next day or the next day or the next day, and it just starts to drop slowly and decay. But at 5 months of age, there's a cliff, and the behavior starts changing. It's like it starts to drop off a cliff, and if a coin can stay in a wallet 5 months or more, it's very unlikely there's a sea change in action that now starts to become more likely not to be sold and held for years and years and years. So this thing takes obviously 5 months for you to reach that. So it's quite a smooth, reliable metric for the macro. And what we're doing here is running the demand supply over this definition of what is on the demand, which is hodling, and what's in the supply, which is the higher probability of selling. And it's a very clean chart, right? And wherever you see a peak in hodlers versus the hodlers that are potentially going to sell, coins that are under 5 months aging, that's always the bottom. It's always the bottom of a bear market, an accumulation phase or a reaccumulation phase, having pulled back from a prior run. And we're in that right now. once we're at peak, right? We're at peak, and
is it rounding out?
usually
I can't tell from the chart whether that's rounding out or is it still going higher?
it started to round out. We only had like a week or so of data but it looks about right. It looks about where we'll round out. Generally, we stay at peak levels for a few months, but you can't rely on that. What actually is happening is these guys that have these coins that have aged more than 5 months start to sell once we get a very, very strong rally, and then you'll start to see this number start to decline. You would have seen this in the last run up from 10,000 to 60,000 from fourth quarter of last year, that we saw like effectively the last generation of those long-term holders start to sell down, and these new guys came in to buy. And it's those guys, they were high net worth purchasers. They were like family offices, high net worth individuals. They were buying like significant, like $1 million exposure at a time. So they weren't like retail, and they were buying and buying and buying. And that's why we're in peak right now, because it's been 5 months since they bought in. The last wave of those long-term holders sold to them. And so we're at that point now. They're aged. Like all the new guys we brought in the first half of this year are now these long-term holders, and they're at peak. And so they're providing the lockup that's necessary to drive us into the the six figure. I'm pretty certain that we're going to go past six figures in Bitcoin in the next, I can't say which month, but within the next 6 months, looking at this demand and supply structure, another 50% climb will be there. I think we're going to do that almost certainly over the next 6 months, probably much sooner. It could be in a month or two or a week or two, the way things are going. But this is a high reliability metric to say we are in for a bull run for the next 6 months or even longer. It could go for another year. So it's a very good time to be accumulating. But we've just coming out of this reaccumulation phase, and can see that on chain very, very clearly. As we did this dip, it was an accumulation. It was not a bear market.